so boring, which makes it so cool.
We were like saying, I'm Doug, and we are looking right now at these five tailwinds.
The tailwinds is reshoring. You have $2 trillion
Love it.
of new commitments. You have robots, which is going to not require you to send goods to China for cheap labor. It can be done here. You have high interest rates. You have 4.25%. Interest rates 10-year was 1% 5 years ago. It was 2% 10 years.
Hi, welcome back to another episode of Resilient Alpha Podcast. I'm Marty Sakata, and today we have Doug O'Donnell, who serves as part of a managing partner of the O'Donnell Group, which is a multi-generational, family-owned real estate investment firm founded in 1972, specializing in the sponsorship, acquisition, and development of industrial warehouse projects across the United States. With over 3 decades of hands-on experience, Doug has been instrumental in expanding TOG's portfolio to more than 24 million square feet of industrial properties, representing billions in project costs, with a focus on high-growth markets in California, Washington, and Alaska. His strategic oversight of private equity vehicles like the O'Donnell Opportunity Fund capitalized on the explosive growth of e-commerce, delivering institutional quality asset management, leasing, and operations through the affiliated O'Donnell Management Company. Doug's MBA and Master's in Real Estate Development from the University of Southern California underpin his ability to navigate market cycles, emphasizing resilient, forward-oriented investments that blend predictable income streams with capital appreciation in the evolving industrial sector. Under Doug's leadership, TOG has positioned itself as a fully integrated operator, leveraging deep market expertise to identify and execute on opportunities driven by technological and investment in economic shifts in logistics and distribution. The firm's published materials underscore a commitment to innovation and property enhancements and tenant selection, particularly for e-commerce fulfillment needs, ensuring portfolios are future-proofed against volatility. As a thought leader in industrial real estate, Doug's insights drawn from decades of developing business parks and managing diverse assets guide institutional and private clients towards sustainable growth, highlighting the niche's potential for strong risk-adjusted returns and broader economic transformations. Welcome, Doug.
Thank you for having me. It's great to be here.
Yeah, it's great. We're in sunny Miami, and a snowstorm's hitting New York in a day, so we're really glad to be here in a lot of ways. But I do have to say that we're here at Polsinelli, and there's a fantastic view of the Bay of Miami. We're next to the Miami River at the mouth. So let's talk about your company and what you guys do. Our group has historically loved triple net lease and industrial. It's been a great, growth provider for us and secure way of investing since before 2007. So in your firm's publications on industrial real estate trends, you highlight the rise of e-commerce as a key driver. Can you share a framework from TOG's experience that helps investors identify and prepare for technology-enabled disruptions like advanced logistics automation and warehouse development over the next decade?
It's an amazing thing is that our company's been in business since 1972, and you couldn't spell e-commerce in 1972.
It didn't exist.
And the great thing about our buildings, or industrial in general, is that those buildings today are still Class A buildings. It's amazing how little technology in terms of design has changed. When you're looking at industrial buildings, there's 7 factors that are major factors. It's design, it's location, it's ceiling clearance height, it's sprinkler system, the truck courts, the lights, and the power, and that's it. And depending on the tenant, they weigh those differently. But in terms of e-commerce, what we're seeing is that only 16% of the e-commerce today is online sales. 16% of total retail sales.
Only 16%. Wow. I thought it would be
which
larger.
Is crazy.
Yeah.
Because me personally, I think I do about 90% e-commerce because I don't care. I have better things to do than go shopping, go into bricks and mortar. And so as a result, that is continued and anticipated to grow by 10% per year. According to the University of Pennsylvania, your alma mater, they're saying that we're going to need 30% more warehouses.
Wow.
By 2030. In order to accommodate the increased growth of e-commerce.
Where are those going to be?
Nationwide.
Wow.
Wherever there's population base. And the interesting thing about e-commerce is that when you have an item that's sold online, it requires 3 times as much square footage than a product that is bought bricks and mortar. So I encourage everybody, you like a pair of jeans, go buy 10 online, return 9, because it increases the footprint of e-commerce and the need for warehouses.
I'm a big fan of online shopping. I actually told my wife, I said, let's go to a real store for shopping on her birthday. And she said, well, just next to me in bed, we'll be done in 20 minutes. So I was like, okay, wow. So that's really interesting. Lots of growth, etc. Can you talk about how your advisory overviews, on private equity funds, how do you envision technology and the impact of things like, AI kind of optimizing the performance of warehouses and the kind of operational resilience you see? As you said, a lot of these properties that were Class A in the 70s are still Class A. So maybe you can talk about how they're adjusting to all these changes that are happening.
Everybody talks about AI. Everybody talks about all this. Truth of the matter is that the original AI was just-in-time timing. And believe it or not, that started in the 1930s by Toyota. But it really didn't come popular here until the 70s and 80s. And that's just what it does. It gets everything together so that it comes together at the same time for assembly, and then it gets distributed out, which reduces waste, reduces downtime, reduces lag time. And so that technology, just in time, has been around since 1930. It's almost 100 years old, and nobody knows that. And so in terms of what we provide as developers, we provide the box. What the tenant does inside is their own business. And what we try to do is design a building or buy a building that can accommodate as many potential users as possible. We do not like specialized warehouses. We don't like R&D because they're too specialized just for unique tenants. We want to accommodate as many potential users as possible. If you look at our list of tenants, they're so diverse, and the great thing about them is that they have absolutely nothing in common. And we like it like that, because what that means is that you can accommodate as many potential tenants as possible. If you look at that list, you have Toyota, you have Court Furniture, Costco, Arco, Ryder Trucks, Volvo. They have nothing in common, which is fantastic. Because if you own a warehouse, you want to be able to accommodate everybody.
Yeah, that's great. I mean, just tell me, do you have separate warehouses for Costco goods and then Costco alcohol? Because I'd like to know where the wine warehouses are located. That would be great to know. So yeah, so that's really interesting. So I know that, as you said, optimization has been around since it was created in the 1930s for just-in-time warehousing, etc. But at the same time, I mean, you've got companies like Amazon now who seem to preload and anticipate what you're going to be ordering and have them nearby. I mean, sometimes you get orders from Amazon or Walmart in a day or half a day, right? I mean, so
isn't that great?
How does that impact? I mean, what is there anything special about your warehouse that you have to do? Do you have to like add new conveyor belts or things like that to make that happen? Or
no, the great thing about warehouses is that there are no substitutes. Every other real estate asset class has a substitute. You don't need to be in an office building. You could be on your computer or on your phone at a Starbucks. You don't need to be in an apartment building. You can be in a house. You can be in a condominium. You don't need to be in a restaurant. You can go ahead and cook at home. You don't need to be in a retail store. You can buy online. Every asset class has a substitute except for a warehouse. And everything you see in this office and wherever people are watching, this cup, your jacket, these glasses, your computer, your mouse, everything has gone through a warehouse. And so it's unavoidable and necessary at the same time. In terms of technology, what we provide is the box. And so the tenants will specialize their distribution and their assembly inside the box. But what we do is we provide the box and we make it accessible to as many potential users as possible.
So you're saying that again, you scope out the industry, you know where to locate these warehouses, you build them, as well as I guess that you will reposition them as well and do things. I mean, do you ever buy anything that's less than Class A and reposition that, or retrofit them, or?
Absolutely. We bought some dirty buildings, and it's great. Developing an industrial is amazing. It's such a great experience. Anybody who's built anything can understand. But
So
to take a piece of dirt and build a big warehouse is a fantastic feeling. And you get the same thing from buying a building. Like, for instance, a typical warehouse, excellent design would be a shoebox, to keep it simple. I bought this one building in Maryland where the loading was at the end of the shoebox. You want the loading at the long side of the shoebox. So what we did is we retrofitted and kept the loading at the end of the shoebox, and then built loading on the side of the shoebox. And it's 300,000 square feet plus or minus, divided into 3 100s, leased it and sold it.
that's amazing. So you have these boxes, you retrofit them, you make them great, and then really it's up to the retailer or the distributor how they use it, and they have their own algorithms are almost like trade secrets, right?
Right.
That's their value add. They come in and say,
Right.
we're going to do it this way, do it that way. We know this has to go out more frequently than that, etc. So that's a really fantastic thing to know. So, you talk a lot about adaptive strategies for dynamic markets. What kind of roles do you see for things like sensor enhancement and things like that in a warehouse? Or, what's the impact of the different supply chain aspects that are happening? I mean, I know that, when we were in COVID, there's a lot of supply chain impact. Did that impact your business at all, or yes or no? Or
well, what happened during COVID is that you saw, especially in the Los Angeles market, you saw rents almost double. And it was a boom time in terms of renting, leasing. And because everybody's all of a sudden discovered e-commerce, it was fantastic for warehouses because the people had never bought online before. They were forced to. And so the e-commerce during that time boomed. Rental rates in warehouses boomed. The problem was people thought it was going to go on forever. And so we haven't bought a deal in the last 3-4 years because of the fact that the pricing has been up here. People thought those rental rates were going to increase, keep going. And so what happened is you had a lag effect where people are still trying to benefit from the sale price. So they're selling Toyotas at Mercedes prices. And we aren't buyers at that. We sold a ton of inventory in the early 2020s. That was very, very good timing. And now we're back in the market because we're seeing that the timing is very, very opportune right now.
what's the impact of things like interest rates? I mean, interest rates went up, and now they're going back down a little bit. Has that impacted what you see? I mean, I imagine that some of the people who currently own warehouses, a lot of mom and pops, they don't have your institutional experience, etc. And they're probably like, oh my God, I bought this warehouse at a really cheap rate, and now my loan rates have gone up. I got to refinance,
Everybody forgets. Here we are today, and the 10 years, what, 4.25 or something.
Mm-hmm.
5 years ago is at 1%.
Incredible. Yep.
10 years ago is at 2%. And so and we have Powell who's leaving in May. And everything I've read is that Trump is very, very aggressive in terms of getting a Fed chair who's going to lower rates.
Industrial doesn't seem sexy. I don't know. But,
right. I go speak at SC or Harvard, and I ask the people in the class, I said, who wants to go into office? Who wants to go to mixed use? Who wants to go into housing? Who wants to go into retail on the bottom and then condos on top? Everybody's standing on their chairs. Who wants to go into industrial? Total crickets.
There you go. Yeah.
Because it's not sexy, which is cool, which makes it so cool because of the fact that it's a backbone of the economy. It's a backbone of the United States. It's a backbone of consumer spending. And it has the lowest vacancy factor in terms of the vacancy rate right now is the highest since 2003. It's 7%. Put it in perspective, office vacancy is 20%. And so if it's the highest since 2003, it's 7%. And there's no new building, relatively speaking, coming online. And so that vacancy rate is bound to reduce.
I'm sorry, you're saying that there's very little new building in the warehouse area?
Absolutely.
Really?
Because what happened over the building during COVID, because people saw the rents double.
Mm-hmm.
And so people came out and they're just banging and building new buildings. And that has been shut off. Absolutely shut off.
Yeah, that's really interesting. I mean, I remember that there was a boom in industrial back in the early 2010s. You'd go like to Exit 8 in New Jersey and there's warehouses everywhere. And then people were like, oops, we don't really, they're too far away from the city for us to do it. So are there optimal locations for these warehouses that you look at? Like when you're, I don't want to get you to give away any secret sauce, but you're like, probably you want to have a warehouse within, 20 to 30 miles, 100 miles. And I guess there's some practicality to having something much closer so you can get delivery easier.
Absolutely. Especially with same day delivery and Amazon Prime and the like, going back to e-commerce, what we talked about, people are getting spoiled and they want everything that same day or next day. And so what we do is we focus on infill markets, major markets of the United States. And every market has the same characteristics. Every market that we would be a part of has an airport, a seaport, and a population base. And what we do is try to get between the airport and the population base, or the seaport and the population base, so that we can do the same day delivery. So our tenants can do the same day delivery.
Got it. Yeah, that's great. So
as opposed to being out in using the analogy of Los Angeles, the Inland Empire, where you have 500 to 1 million square foot buildings, but no differentiation whatsoever. So what does it come down to out there? It comes down to price. Whoever has the lowest basis wins. And we like to be infill, because infill, the great thing about industrial, nobody likes it. It's essential and hated because of the fact that there's no tax base. Cities hate industrial. There's trucks that create pollution and noise. They tear up the roads. And when you have one, it's really, I call it concrete gold, because of the fact it's grandfathered in. If it were to come up again, it would not be zoned industrial. They'd want to put in apartments, they'd want to put in retail, they'd want to put in something with a tax basis, something with sales tax. Industrial doesn't provide sales tax, and it doesn't really provide jobs, because on a warehouse,
I was going to ask that question, right?
On a 100,000 square foot warehouse, you could have 10 employees. 100,000 square foot office building, a ton more than 10
Sure,
employees.
Right. Yeah. So you're right. From a tax basis, it's right there with storage or something like that.
And the barriers to entry are immense, because it's so difficult, because cities don't like industrial. So in order to go buy land and build a new industrial building, very, very complicated, very, very long period of time. And nobody wants you there.
But I think
so it's better to buy existing infill.
I think we're looking at a period, though, of demand on all sides, right? Because it's not just going to be coming from e-commerce, but I also think that the government is going to be spending a lot more. There's going to be a lot more manufacturing in the U.S. Things are being brought onshore. It seems like all the factors are favorable.
It's so great because of the fact that if you look at the onshoring, and you heard it yesterday, Trump in Davos, America first, and the like, and that globalism, they're very anti-globalism. And the components of that is, if you look at your phone, I mean, this phone right here, how many components do you think are in this? And Apple just said they're going to come back and invest $600 billion. The answer is there's 2,700 components.
Wow. That's a lot.
In this. In a Ford F-150, there's 20 to 30,000 components. And so when you have a phone like this, the trickle-down effect of suppliers supplying the components to said phone is like that. And so with the reshoring and onshoring, it's going to increase the need for industrial real estate. And also, people aren't talking about automation. People aren't talking about robots. So what's going to happen when robots, according to Elon Musk, are going to be better at brain surgery than doctors? Are we going to need cheap foreign labor if we have domestic robots? And if that's not the case, and they're able to sort boxes, if they can do brain surgery, I'm assuming they can sort boxes in an assembly line.
Yeah.
Do we need to be sending stuff to China for assembly and for manufacturing? Or is that all coming back here and staying here? So in addition to reshoring, you have automation. And so by building things here, assembling things here, you don't need to ship it back and forth from China. A, it's costly, and B, it also takes time.
That's fascinating.
Which increases the need for domestic real estate, industrial real estate.
Yeah, I mean, as I said, it's kind of like you've got all kinds of tailwinds right now, where there was headwinds maybe 2 years ago. As you said, it was overbuilt. And now there's so much demand that's going to happen because of all of these trends. So, another quick question is, when you structure your deals that you do, they're all triple net leases. What's the duration for a typical deal? And can you take people just for a minute or two through how your triple net leases are put together and how you kind of make it so that it's neutral towards economic factors for you?
Sure, it's just the industry standards. It's nothing proprietary. It's not like we made it up or anything. But truth of the matter is that the triple net leases, if taxes go up, tenant pays. It's not the case in office. Office, you have full service gross leases with typical expense caps. And triple net is an industrial thing. And it's unique to industrial. And so if taxes go up, tenant pays. It's not like that scene from the Goodfellas. Taxes go up, tenant pays. Landscaping goes up, tenant pays. I'd use a profanity, but we're in PG.
Luckily, we don't have Joe Pesci in this
exactly.
podcast. But
and cost of insurance, which is a big thing in Florida, goes up, tenant pays.
Good, yeah. I gotta imagine that protection from hurricanes and things like that probably is costly. So your target is, how would you describe it? 100,000 square foot is a typical target you're looking for in a Class A city, with an international airport?
It's less square footage based, and it's more size based, because 100,000 square foot building in Los Angeles is a lot more expensive than 100,000 square foot building in Oklahoma. And so it's really a case that we focus on deals that are about $25 million. Too small for institutions, too big for private guys. And so we've been very successful in that size range.
When you do that deal, typically it's what percent is the equity and what percent is the finance? What kind of...
We don't do anything exotic. We're right down the middle of the fairway, where it's about 35% equity and 65% debt.
So, right now, I guess, the U.S. industrial base is about, 18 billion square feet. And what kind of growth can it absorb from the current trends? And like, how fast can you build out, given that, as you said, nobody really wants to zone for warehousing?
That's great. What we see is the case that there's going to be additional need for 30% more warehouses or e-commerce.
And that's in the next 5 years, 10 years? Wow, that's a lot, yeah.
According to Wharton. And as a result, we're focused on the existing product. And so the existing products obviously is going to lease first. So right now you have an interesting situation where you have vacancy rent at the highest since 2003 at 7%. You have no new product coming online. So you're really, right now, you're buying low. And interest rates are at 4%. 5 years ago, they were at 1%.
What, are you seeing a lot of distressed deals?
2%.
Right.
No. And that's why it goes back to the fact that with an 18 billion square foot base, it's a very, very solid and secure asset class. It's not specialized. It's not trendy. There's nothing new about it. As I said, the warehouses we built in 72 are still functional today. And it's the existing inventory is going to lease first, and eventually there will be more building.
So what's really interesting is that this, industrial is not like Hollywood, right? I mean, it's not glamorous, as you pointed out already. And a lot of times you have to find this industrial properties in places that other people wouldn't look at. They were putting up office, right? Like, so I'll take you through a brief run. Many years ago, I was working with an industrial firm, and they were doing all distress, and they found like a guy in Hialeah who owned 50,000 square feet on the railroad tracks. and his partner was going through a divorce, so they had to get rid of his partner's piece. And he decided he was already 70 years old, he wanted to get rid of it. I think Queens and Brooklyn have had an explosion of some of their industrial, because a lot of the industrial was converted back in the early 2000s into lofts and apartment buildings. So then all of a sudden, what demand then kicked up because of e-commerce, as you said. You look at the deal that was done in Philadelphia with the Navy shipyard. There was that big warehouse that was sold to Amazon. You go to, again, to Opelika in Miami, there's that huge Amazon center there. I mean, you really have to look where other people aren't thinking. I mean, it's intuitive because you're multi-generational, but it's not intuitive if you go to Harvard.
Absolutely not. And that's why, people getting into business, I say the most important thing that you understand is the brokerage standpoint. You have to understand the product. And that's where a lot of people fail, is because they look at it as a commodity. Real estate is not pork bellies. It's not coffee futures. Every building is different. Every building has a story, and you have to know why it works.
Yeah.
And why it's there and what tenants you're trying to accommodate using those 7 factors that I previously explained. Each tenant is going to weigh those factors differently. And so we've been very successful in Memphis, Tennessee, Indianapolis, Phoenix, Trenton, New Jersey, Bordentown, New Jersey, Swedesboro, and Miami, of course, and Los Angeles. We've been all over the United States.
What about other high growth areas like in Austin, Texas, or?
The ironic, everybody talks about Austin.
Yeah.
Has the highest vacancy rate in the United States.
And how's that?
13.6%.
But they've had tremendous growth.
Overbuilding.
Right? Overbuilding.
Everybody was drinking the Kool-Aid and they overbuild it.
How does it compare to a place like Dallas, which is my favorite city in Texas? But
I love Dallas, but there's a ton of land. The number one lowest is Columbus, Ohio.
Okay.
The Rust Belt right now has the lowest vacancy because when everybody was looking at the Sun Belt, nobody was looking at the Rust Belt. And so as a result, nothing new was built. And the Rust Belt from Chicago, Cleveland, Columbus, Ohio, Minneapolis, all are very, very strong, low vacancy markets.
And that's where a lot of the manufacturing will go back to, because the Rust Belt is wired. I mean, they have the electric going in already. They don't have to build new, wires going into these warehouses or to the manufacturing center. So it's wired to build stuff.
Right. But even no matter what the market is, we can always find an opportunity. Because somebody will say, even let's use the worst case scenario, Austin, Texas, 13.6% vacancy. That you have to narrow down those numbers, because that may not mean units under 5,000 square feet. Small bay is completely different than big box. And so big box, 1 million square feet, which there is a glut of nationwide. Because because everybody thought Amazon was going to.
Because 50 people built for the next Amazon, right?
Right. So it's been, there's current glut. We don't do outfill. For lack of a better term, outfill is the opposite of infill. Infill, I like right around the airport, like here at Opelika, Hialeah, we have properties. I love it because it can address the immediate population. Mm-hmm. But we don't do outfill just for that reason. And so there's always a story within the story. And real estate's not a commodity. It's not pork bellies. And so you can find opportunities in each market. It could be a case that you have 13% vacancy, but in that same market, the small bay industrial vacancy could be 4%, which would be great opportunities.
Do most of these places have like spurs onto the railroad also, or things like that? Or?
Yeah, rail's important. Rail and ceiling clearance height never killed you if you have it, but it will kill you if you don't have it with certain tenants.
There was all this talk, and of course, the Panama Canal was expanded, right? And there's all this talk about all this expansion of ports. So like the port of Charleston was expanded, the port of Savannah,
port of
Miami, right?
It's super deep.
Right. So was there did they build out a lot of warehouse as well for those ports when it happened, or are they still in need of building out more capacity?
Well, it's a loaded question or generalization, and some of those markets like Savannah is a great deep water port, in Miami, obviously. And then you go up to Norfolk, and then you go to New York. The interesting thing about New York, that's why they're increasing the Bayonne Bridge.
Oh, really? Okay.
Because it's not big enough for the super tankers.
Are you serious?
Yeah.
Wow.
And so that's why they're going through and raising it, because it's obviously
I didn't know that.
biggest market in the United States.
Makes sense, yeah.
But the super
But you can't
tankers can't get underneath the bridge. So
right. Those
that's
people
why
going to LA for
right. So that's why they're raising the bridge, so the super tankers can get in there.
And you only do domestic USA or North America?
Only U.S.
Yeah. I know the Chinese just built this massive port in Peru, which there's no warehousing there. That build out's gonna be happening for a long time. So
yeah.
So you've got some great examples, and we're gonna attach your deck to this presentation when it goes out. But you've got a couple of great examples of what you call industrial porn. I don't know, it looked kind of boring to me. I guess if you like Sidney Crawford and you put a box around here, maybe that's like industrial. But take me through like an example of one of these. One of them looks huge, like it's next to an airport, and the other one, looks like it's a bunch of bays. Tell me about this. We will post the slide.
I love industrial because of the fact when I was growing up, my dad was into it, and on Saturdays after my baseball game or soccer game or football game, we get in the car and go look at the warehouse sites.
Yeah.
Because they're under construction. And if you have the opportunity, you got to see a wall tilting process. When an industrial building tilts the walls, it's magical because you have these panels that are like 60 by 60 going up, tilting up, and then getting put in place. It's so much fun to watch. It's incredible. But, that's why design is so important, because anything other than a shoebox, that's a deviation from perfection. And you can get around that if you can create demising walls accordingly. But typically what you want is a shoebox. And people get really screw that up, believe it or not, more than they should.
Interesting. We had talked a little bit about, e-commerce and retail sales. I think it's growing. And, on the one hand, every kid kind of grows up native with a cell phone, that's a smartphone, and, et cetera, et cetera. But even though people are living longer, I'm finding that older people are getting a lot more proficient at using cell phones and using e-commerce. I mean, there's a lot of people I know who are in their 70s and 80s, and they have like social media groups. They would never go to a store again. Talk about the growth and how that impacts what you're doing.
I must be 70 or 80 because it sounds good to me. We don't do anything in terms of specializing our buildings for e-commerce or same-day product, except for the fact we buy infill and we buy next to or in the middle of population bases. There's no special technology that we do. As I said, since 1972, when my dad developed his first project, we still actually own the building today. His first development he did is in Montebello, California. And the only thing that's really changed is 24-foot clear, which if we build it today would have 30-foot clear, because you increase the cubic capacity by 50%, and yet the floor plan stays the same, and tenants are charged by the floor plan, not the cubic capacity.
Right.
And so, and then the truck core is probably 100 feet. In today's day and age, you probably want to have at least 120 on infill. 120 is fine. 160 is amazing. And then sprinkler calcs, you want to have a strong sprinkler system, because if you have somebody who's storing tires, you need to have ESFR sprinkler systems, which is early suppressed fast response. And it's just a deluge, 100 pounds per inch of pressure versus typically, which is about 33 to 45. And then power has increased. It used to be a case that we had a need for 400 amps for power because people were just had the lights on because they're distributing product. And now it's more like, if you're build spec, you're probably looking at 4,000.
So you got to, and I'm going to say, I know this business, but I really don't know the business, but you've got this whole, lineup of potential, buyers who will use your spots, etc. When you buy a new warehouse, do you go and say, do you go back to your suppliers and say, hey, I have something for you in XYZ spot? Or do they say, hey, I'm thinking about, doing more delivery in Des Moines, Iowa. Do you have anything there? Because we like working with you. How does that, can you talk a little bit about how that goes in terms of like, your business networking, the idea before you go through with the activity? Or, I'm saying when you buy a building, do you know exactly what tenant or type of tenant you want to put in that building? I know,
absolutely not, which is great.
Okay.
You have no clue who the tenant's going to be.
Okay.
Which is fantastic. And that's why it's important. And that's why I've been in business since 1972. You know how to design the building to attract the most amount of tenants as possible.
And when you go to contract with a tenant, you have some specialty changes they may want you to make you do those changes, right? It's not up to the tenant to do those changes, right?
But that's the great thing about industrial is the fact that if you have, let's say you had a restaurant and it's an Italian restaurant and you want to change it to a sushi bar, that's going to take you at least a year in permits and construction to convert it. Plus probably $100 a foot minimum, $100 a foot to $500 a foot. And with industrial, if you have somebody who's storing coffee cups and the next guy's storing computers, all you have to do is sweep out the warehouse. And so the downtime,
them any specialization they do.
Correct, because they'll put in their own racks and they'll put in their own automation system, if any. And so all we do is we provide the box, and so we're indifferent.
So we had talked about these tailwinds that you think the industry. Can you kind of summarize that? Because it'll make a nice soundbite about the tailwinds behind industrial. If you were like saying, I'm Doug, and we are looking right now at these 5
you
tailwinds.
Have, okay, the tailwinds is reshoring. You have $2 trillion of new commitments. You have robots, which is going to not require you to send goods to China for cheap labor. It can be done here. You have high interest rates. You have 4.25%. Interest rates 10-year was 1% 5 years ago. It was 2% 10 years ago. You have positive absorption. You have the highest vacancy rate at 7%, which is still very, very low compared to other asset classes and very, very normal. And you have an industrial base of 18 billion square feet. And so it's not a niche market. It's a very, very stable, sturdy, boring. It's so boring, which makes it so cool.
Fantastic. Great. So we talk a lot about, what you're doing in terms of, when you spec it out, but because you've been in this business since almost more than 50 years now, right? Do people look for you? Do people have you on their Rolodex and say, I got to give Doug a call because, I got this property and I really just want to sell it. I know he's buying. Right?
I wish that were the case, but people's memories are very, very short.
Really?
And when you go to sell a property, myself included, I don't shoehorn anybody in. I take it out to the market and try to get as many buyers as possible.
So everything goes almost like to auction, let's say?
Yes.
Wow.
I absolutely. That you have the highest chance of getting a top dollar.
Is there typically a broker involved?
Yes.
Or do you ever work with people who are like, backdoor brokers who like kind of are talking to people? Or no, you don't do that.
No, we go to auction.
Yeah.
No, because believe me when I tell you, I've been the beneficiary of backdoor deals and side door deals and getting shoehorned in and bro deals. And we've made some great deals that way. But when we're buyers, we love that. When we're sellers, we're going to auction. That's because we want to make sure everybody's seeing it.
Right. So as a seller, always auction. But if you can get a good deal, you're going to take a look.
Oh yeah.
Yeah. Because that's part of, we found that with many successful managers and fund managers is that the fact that they've been around for a long time actually gets them into, somebody's vision for selling faster, and that's great for you guys that have been around for so long. So, talk about a typical investment term that you may have, in terms of the total equity you're looking to deploy, the leverage, your hold period, et cetera.
Yeah, our typical deal is we buy properties that are about $25 million. Our typical hold period is 3 to 5 years.
Are those repositionings or
repositioning, value add and core plus?
What? I know that a lot of people like to convert warehouses into lofts back in the day, but what converts into warehouse? Does any, like department stores sometimes convert? And
I don't know. You're talking about Queens and the Bronx. Those are when you have multi-story warehouses. That's not our program.
Oh, we had amazing deals coming out of those areas.
I'm sure you did, but
you had these.
There's all these New Yorkers who know that market better than me. I'll leave it to them.
It's a remarkable because of the whole, back in the day, the 5 and dime and now the dollar store sort of products used to come out of China and Japan.
Right.
And people could build these massive warehouse empires, basically just taking every crazy thing that came out of those countries and selling them to kids and things like that. So yeah, remarkable. So now we're gonna take a 1 minute break and then get to the lightning round. It's just gonna be 10 questions and a bunch of 30-second answers. So let's take a break. Before we get into the lightning round, Doug. So I had a question. If imagine you're talking straight into the camera and somebody's asking you, what are the tailwinds behind industrial? Well, how would you answer that question?
It's an amazing time because e-commerce is growing 10% a year. And you have a fact that you have a need for 30% more industrial warehouses between now and 2030. In addition, you have stable market vacancies at 7%. To put in perspective, office is at 20%. 7% is remarkably high for industrial. It's the highest since 2003. In addition, at the same time you have high vacancy rate, you have very, very low new supply, the lowest since 2018 in terms of new construction. And you have high interest rates that are about 4.25% to 10 year. 5 years ago is at 1%. 10 years ago, it was at 2%. And you have a new Fed chairman coming in May, and Trump has told us very directly that he wants interest rates coming down. And then you have reshoring. We have $2 trillion worth of new commitments, both foreign and domestic, bringing manufacturing back to the United States. And so as a result, that's going to increase the need for industrial warehouses.
So, there's certainly been a big AI craze, and we hear people talk about AI this, AI that, data centers. We had like a mini nuke company present to us on these massive power plants they need to supply these data centers. But nobody's talking about how they're going to get licenses to transfer nuclear material. Virginia, they have a new governor, and she's totally against data centers. She just
as she should be. Their dream.
So data centers, sexy. Warehouse, not so sexy. Can you just do a comparison? Because it seems like, warehouses are here and data centers are somewhere in the future.
I like playing musical chairs with my grandchildren at someday. And the truth of the matter is that a data center costs roughly 10 to 30 times more than a warehouse. And so eventually that song is going to stop and you're going to be stuck with an asset that's 10 to 20, 30% more than a traditional warehouse.
Is that like wiring, refrigeration, electricity usage?
Power, and nobody likes data centers because they drain on power. I just read that NVIDIA on January 6th, they came out with a chip that doesn't require cooling. So for me, it's a technology play. And if I want to risk technology, I'd rather buy a technology stock than bet on data centers and physical assets. It's like betting. I have a better bet on who's going to win the Super Bowl 3 years from now than what technology is going to be 3 years from now.
I mean, obviously the big problem is that you might build the building, but somebody's got to put plumbing into it and the wiring. And who knows when they're going to move. I mean, you're not
just so oversupplied, and they're out in the middle of nowhere, and I'm very, very bearish. I mean, there's need for them, but it's a timing play and a technology play. And so on the technology play, I'm not in technology. I'm a warehouse guy. I build warehouses. And so that's enough risk for me. I don't need technology risk in addition.
Fantastic. Great. So let's move to the lightning round. Okay. Let's talk about a couple of different trends in the industry, et cetera. And we're trying to be future looking. So what's the one trend that investors and funds should be looking at when it comes to, your warehousing offering and tenant selection and leasing strategies? Like, is there a specific trend in there that makes it more desirable or less desirable? Or
isn't that great? It's not trendy at all. Nothing's changed.
The trend is no trade.
Exactly. If you want tech stocks, go buy tech stocks. But the great thing about industrial buildings we've had since 72 are still absolutely functional today. And the markets that we've been in since 72 are absolutely in vogue today. Nothing changes. What goes on inside the warehouse changes, but the actual warehouse, a shoebox, truck court, ceiling height, power, sprinklers, doesn't change.
Everybody talks about all this new robotics in warehouses like Amazon, et cetera. Is there need for more power coming into those warehouses as a result of that? I mean, on the other side, I guess that everybody talks about the fact that with robots operating everything, you need less lighting because they don't need the light to operate. They just knock stuff out.
Yeah, that's true. But yes, the trend is definitely where buildings need more power. And it is such a pain in the ass because what happens is you go to the city and you want to have 4,000 amps. That's kind of like the new Mendoza line, if you will. And so 4,000 amps is what you want to have. And the city says, show me your tenant that needs 4,000 amps, but they don't need it. You're projecting in the future. And they say, well, we aren't going to provide it for you. And then you get a tenant who needs 4,000 amps and they say, well, it's going to take 2-3 years to get it to you. And so there's a very big disconnect on warehouses and power. But the trend is definitely for more power. And that's going to be a requirement for charging trucks, charging cars, and charging robots.
So somebody comes in with a truck, maybe it's an electric vehicle or something like that, and they need to be able to charge at your place too.
Yeah, presumably.
Yeah, interesting. Yeah. So what are common pitfalls that investors make when investing in industrial?
They absolutely treat it like a commodity. And you have to know corner by corner, you have to know the design, you have to know of those 7 factors that are involved in a warehouse, which ones are important in that market, because it varies market by market and it varies building by building. And so it's not a commodity. That's why I'm so thankful I had the brokerage background where I understand which buildings work and which buildings don't. You could, to the untrained eye, look at 2 warehouses and say, well, it looks the same to me. But the truth of the matter is they're completely different warehouses. One will stay vacant for 2 years, one will lease in 2 months.
Interesting.
And that just comes with local knowledge. That comes with knowledge of doing this for all my life. When I was growing up, my dad was taking me to warehouse sites to see construction and explaining what was going on with the construction. My son is been with us for 5 years. He's finishing up his MBA at Wharton, so he's a 3rd generation. And so it's a 3-generational company. I'm very, very proud of my son and my father. My father and I were very, very tight. And it's so much fun. It
sounds like a smart kid. So let's talk about, all these changes in warehouses again, and what services that the warehouse has to offer for the person using it. So we had talked about reshoring and manufacturing. Talk about how that's going to impact supply chain. So instead of like a bunch of stuff, as you said, 27,000 components in a Ford truck or something like that, coming over on a massive, tanker from China. And now instead it's going to be manufactured somewhere in the United States or Mexico and sitting in a warehouse. How's that going to impact demand? That, it's going to be somewhere in a route between a manufacturing state and a state where it has to, get looped in and assembled, and also the fact that maybe it's not coming out from a massive port. So how does that impact your logistics in terms of deciding where to buy?
We like pro-business states, Texas, Florida, Tennessee and the like.
They're also growth states.
Yeah, there's growth states, but you know, we've done business in Trenton, New Jersey, and we've done business in all these states, in Indianapolis and Memphis, Tennessee, and we've been very successful there. And so it always comes down to a population base in an airport or a seaport and getting right in the middle of them.
And how business friendly they are, because probably a business friendly environment will say, sure, you can relicense your warehouse for 4,000 amps. Right?
Yes, but it still takes time, because that's the government, and that's the utility company, which is separate from the government and the planning department and the permitting department.
There's some, revolutionary technology that's obviously happened in real estate. There's a lot of software providers that do all the analysis for you, and they have 35 different ways for you to look at buying a deal. Are there any new analytics on deals that you look at that would make you say more favorable in the next one? If, you've got two boxes on, across the street from each other, and, what would you say is something that, is more appealing?
No, everybody has the same technology. Everybody has CoStar, everybody has Crexi, everybody has a CBRE, Colliers market reports. Everybody has the same information. When I started, the information was much less perfect. And that's a great thing about industrial real estate. It's a very fragmented market. It's not a perfect market, which makes it, if it were a perfect market like soybeans, I wouldn't be in business. So I love the fact that it's fragmented.
So you're saying it's can you talk about how fragmented it is?
Yeah, there's no one major owner. And so there's no price fixing, there's nothing. And
are there REITs that are?
Yeah, they're REITs.
Like, do they own 5% or 1% or how?
I couldn't tell you.
Okay.
I don't know. But like Prologis would be the biggest industrial REIT, and they do a great job. They're great management, and they buy Class A properties, and they do an excellent job. And
sell to them?
Oh yeah, I'd love to. I don't think I have. I don't think I've sold to Prologis yet. Not opposed to it.
Your hold time is 5 to 6 years?
It depends. We've done it 1.25. We do it just long enough to get capital gains in some situations, and sometimes 7 years. Sometimes we hold forever. Like the project in Anaheim, we have a project in Montebello where we've held since 1972. And we have other ones.
You just refinancing it out, etc.
Yeah. And then one in Anaheim that we've owned for 20 years, and Santa Rosa we've owned for 30 years.
What's the number one trend that underscores why industrial still remains a resilient investment?
Because of the fact it's unavoidable and there's no substitutes. You have to have warehouse. Everything that comes in, everything you see goes through a warehouse. There are no substitutes. And so this has gone through a warehouse, your sports code, your computer, your iPhone, this phone, everything.
So very little goes from manufacturer to consumer.
But manufacturer is manufactured in a warehouse.
That's what I'm saying. Right.
So it's unavoidable. You don't need to be in an office building. You could be on your phone, or you could be on your computer at a Starbucks. You don't need to be in a retail store. You don't need to be in a restaurant. You don't need to be... there's substitutes for all that. There's no substitutes for industrial.
Fantastic.
And 75% of our economy is consumer consumption. And so as a result, all that goes directly from the warehouse to the consumer.
Fantastic.
So as long as we keep buying stuff, which I don't see us changing, there's going to be a need for our warehouses.
Excellent. Well, fantastic, ladies and gentlemen. That's our episode with Doug O'Donnell of O'Donnell Group. We're going to publish his contact information, and we're going to attach a deck that you all can download to get more information. So thanks so much for watching the show.